Let us now start off the event with the 2022 Economic Outlook that will be presented by Mr. Suan Teck Kin, our Head of Research. He is responsible for macroeconomic and foreign exchange research with a primary focus on Asia. He presents the team's markets views regularly to the media and clients too, so you might find him familiar. You might actually recognize him because of his frequent appearance on TV. Now, without further ado, I will hand over the time to Teck Kin. Teck Kin, please.
Thank you, Patricia. Good afternoon, everyone. Really happy to have everyone here joining us, our Global Markets event today. This afternoon, we will have an exciting lineup of event like what Patricia mentioned just now. So for now, I will just share with you over the next 30 minutes or so, the key themes and opportunities and also things to watch out for this year that I think companies and also even individuals should take into account in their investments, in their business operations. Okay, so there are a few things that I would like to share here. In terms of inflation and Fed, I think these are the key topics of the day, and then we should really pay close attention to that. And then burning questions on ASEAN and also China that happen all the time, and I'd like to address some of the key risks that we should watch out for China and how should we think about that risk. And finally, for those who are in Singapore, I think there are three rates that we need to think about in Singapore. One is, of course, interest rate. What should we do about it? And then second one is inflation rate, right, in terms of cost to business. And finally, the GST rate. So these are the rates that I'll be talking about for the Singapore segment. Okay, for the first segment on inflation, Fed, and also China, let's take a look at, let's get this COVID-19 out of the way first in terms of the Omicron. All right, for Omicron, I think quite a bit of worries when it first started in November, late November, when it first popped up, and I think a lot of people are worried. Were worried, what should we do? Is it going to be very bad? How bad is it going to get? So at that time, our team got together and came up with this scenario for the Omicron, right? And then we decided at a point that this Omicron, yes, is a risk that we need to watch, but we don't want to be overly pessimistic about it. So in the end, we came up with this scenario for Omicron as in the traffic light system, being in the amber situation. Amber situation for Omicron, which is, well, there's downside risk that we need to watch, but overall, I think we should be okay. Okay, then the more pessimistic one is that, of course, a red traffic light. But why is it in an amber situation? The very important thing is the vaccine at the time, people are not sure whether it will be working against Omicron or not. Then we found out as we go along, we find out that vaccine actually work quite well against Omicron. As long as vaccine can work well, as long as hospitalization rates are manageable, the death rates are manageable, then we should be okay in this amber situation where we have BAU, business as usual, with some adjustments that we need to make. So there was a time, at that time, we thought about this Omicron and how we frame our thinking around this. So if Omicron was so powerful that the vaccination could not work and then we had to restart, what would happen? Then it will be back, it will be in the red situation, red traffic light, where we go back to early 2021, when the Delta first hit and vaccination wasn't so prevalent yet in terms of the rate, in terms of the scale of our vaccination. So here we are, the numbers and also the reports that we see so far, I think justify our amber situation. Okay, so that's what we have right now, a bit of BAU, going forward, some adjustments, maybe some downside risk. All right, but we don't want to be overly optimistic and say that at the end of the world, we have to go into the red situation and back to lockdowns and all that. Okay, so here it is. We have the three scenarios. But one thing you'll note, somewhere in the middle of these three scenarios, somewhere in the middle of the chart, we talk about inflation. Right? Under these three scenarios, take a look at the inflation situation. Is still going to have upside pressure on inflation, right? Whether you're green, whether you're amber. And that's a common thread around it. And in the red situation where things get really bad, inflation risk could actually be higher, right, because of the disruptions. So inflation is one thing, and that's my next topic is about inflation and then the implications on Fed interest rates and also the local interest rates that we need to watch. Okay, so here it is. Inflation is one thing that we watch, and I just want to show you quickly on US inflation figure since 1984, the highest over the past few decades, 6.9% for November. And tonight you'll receive the December US CPI report, and then you'll find out is it going to be above 7%, and how much is it going to be above 7%? And what are the causes, what are the components that are driving the inflation rate? You can see that on the screen here, basically all the components are driving inflation higher since somewhere in middle of 2021, right? All the components, the transportation, the rentals, even apparels and food, F&B, and all these components driving up the overall headline figure. When the central bank look at these headline figures, they would have to do something, right? They have to react using their policy, whatever it is that they have to deal with this situation. They cannot just say that, oh, well, my policy tool cannot really address a supply side issue, so I'll just leave it there. No, they cannot do that. So they have to react to this inflation. But first, let's get through to what are the major causes for this inflation suddenly jumping up. Okay, three causes that I can think of, three causes that we come up with. One is basically the logistics issue, the logistics supply chain disruptions that we have been seeing for the past 1 year or so and filtering through to 2022 as well. For example, just a quick one, shipping costs. Shipping costs out from China have improved slightly on the screen here, on the chart, improved slightly, but still we are talking about double-digit year-on-year increase for most of the places. Right? Even in Europe, it's actually triple-digit increase year-on-year. Shipping costs very expensive, and that goes into your cost of production as well and cost of selling. Okay, simple as that. And then once the ship arrives at the port, then another logistics problem for those port operators in the US and possibly in Europe as well. The port workers cannot unload the container boxes fast enough. So if you have that situation, for instance, in this case here, for Port of LA, in this picture here, 18,000 boxes they can handle a day. But they have 500 over 1,000 boxes waiting at the port. And there are new ones that arrive as well. So this logistics issue can resolve itself, but it will take some time. And meanwhile, the numbers for the inflation will just continue to move higher or even stay at a high level. So logistics issue, need to deal with that. And why is that you have this logistics problem? The other one is, of course, some of the workers, if they get sick, they cannot go to work, right? So there's labor issue as well. They're facing labor supply issue in many, many places, not just in the US, they are in Canada, Europe, and Asia as well. So you hear about shortages of labor in, for example, in Malaysia, the palm oil seeds, the palm oil fruits just fall on the ground because they don't have enough workers to harvest the fruits, and they just rot on the ground. Right? So you have stories like this, you have situations like this that cause a problem in your production, in your delivery, in your selling as well, right? So you have a labor market issue, and then you cannot get your goods fast enough to your consumers. When you cannot get your goods fast enough to consumers, prices will have to reflect that as well. Okay, so logistics, and then labor market issues, and then of course the last one is more familiar to many of you, is the commodity prices themselves have already gone up quite significantly. You have the gas prices, going up quite significantly. Used to be about below $2.50, and it's gone up to as much as $6 per unit of the natural gas. And of course, soft commodities as well. And crude oil prices, for example, now it's $80 over. Maybe last year, we were talking about $50, $60. So at the oil pump, when you pump petrol for your car, then you can feel it quite directly. Unless you drive an EV, then you don't have a problem, right? You don't have to worry about your crude oil prices, which sustainability topic will be discussed later in a later panel. Okay. So anyway, so all this inflation issue, is it just US? Although I use US as an example, no, it's not. It's actually a global issue. Take a look at the chart here, where the diamonds, the blue diamonds, are the central bank's target for my inflation for this particular country, for this particular area. The red ones are the average inflation rate since 2021 January. So as you can see, at the bottom, you see the difference. Singapore, on the right-hand side, anything that left of Singapore, the local inflation rates have already more than exceeded central bank targets. So when you're more than exceeded central bank targets, what do? Central banks would have to act, and some of them have already done so. For example, Bank of England, Bank of Korea, and many other, quite a number of central banks have already reacted to that, right? Pressured by higher inflation. So, and Singapore has already done that as well. Back in October, through the Sing Dollar NER policy slope, right? So this is a kind of a reaction the central banks will have to do, and of course, the US Federal Reserve would have to address that issue as well, right? We have to address the issue, and what we are looking at for this year, for the US Federal Reserve, is our house view is for 3 rate hikes from the US Federal Reserve. We will start in June, 25 basis point, and then go on to second half of the year, another 2 times of 25 basis point, 0.75. By end of the year, it will be at 1% for the Fed funds rate, right? So that's our current house view. But of course, in the recent market actions, last night, Jerome Powell talked about doing more in terms of controlling inflation, managing inflation, so through interest rate. So now the market is talking about maybe 4 times of rate hikes. So this is what we have right now, about 3 times. So that means there's upside potential for interest rate, upside potential for the US rate, and therefore it will translate to, in Singapore and other parts of the world as well, higher interest rate ahead of for this year. So we do have to manage that, and our colleagues here will be able to answer some of these questions later in the panel about interest rate outlook. Okay, so one question I want to address now about this inflation is that, would it cause some kind of stagflation in, let's say, in the US, right? Because of high inflation, and then you have the interest rate going up, could it cause a recession? Let's take a look at this, the slide here on the screen, where you can see the average length of the US expansion cycle. The average length in the middle, the mean 1960 to 2020 is about 43 months. So that means after 43 months, there's a recession, right? 43 months on average. But here, where we are right now is at the bottom, at the post-pandemic line. We are at about 22 months right now in the business cycle. So assuming that we have an average expansion cycle here this time around, average. So that means we should still have another 20 months or so to go, and another 1 to 2 years to go for the business expansion cycle in the US. Okay, so unless bad things happen along the way, but if it's if it's managed well, the central bank handles the rate hikes in a measured manner, no surprises there, no surprises from the COVID-19 situation. I think we should be able to hit at least on the average 40 over months of expansion cycle. So there's still some room to go. What's the longest expansion cycle in the US? At the top of the screen, 128 months, right? So about 10 years of the cycle before hitting a recession. So if you're lucky, we could even get that, a long expansion. So as long as the US expansion cycle is intact, and that will benefit places like Singapore and also the rest of the world as well. All right, so the stagflation is always a risk there, but I would not place too much probability on that part of the stagflation being the main scenario that we are facing. All right, so here it is, interest rate going up, and what would happen to our Singapore interest rate then? Okay, let's take a look at for the Singapore interest rate, I think my colleagues later will address that issue. For the SIBOR, the 3-month SIBOR, 3-month SOR, and all those, by end of the year, we should be heading towards the 1% mark. Okay, so what should we do about it for companies? How should we manage this? Higher interest rates are coming, potentially even higher. Although on the screen here, what you are seeing is that our business expansion in Singapore, in around the world, I think should be a moderately, quite a good year for 2022 as well. Okay, so the steady expansion, for example, for Singapore, after the 7.2% growth last year, I think this year we should be able to look at about 3.5%. For China, somewhere later I'll talk about China, 7.9% expectation, close to 8% for 2022, about 5% or so. I think even at the 5%, I think should be quite decent because the size of the Chinese economy has grown larger, right? So it's off of a bigger base. So we should be quite comfortable, even with a 5% expansion for China. So as long as these big economies are moving along, that should benefit places like Singapore and ASEAN. But we do have to keep an eye on our interest rate. So very important. Okay. All right. Let's take a look at China. I think China won't. I think there's always interesting questions coming out about China, and people want to know how is it going to perform this year. I think overall this year, I think should be another just a moderately expansion year, moderate expansion, 5%, 7.98% last year. So here, disappointed in the third quarter with only 4.9% growth, right? Because of some of their own issues within China itself. For example, electricity rationing that they have, and also some logistics issue as well in China. So that caused a bit of a slowdown. And then going to this year, first quarter, I think we should be expecting about some recovery into the first quarter, and then for the rest of the year as well into the 5% sort of range. Again, we still have to remember these numbers are off of a bigger base, right? It's a much bigger base, 100 over trillion RMB in China in terms of the size, second largest in the world. So we should not be expecting, another double digit. Why not another double digit growth for China? Because the base is much larger already. Okay, so that's something that we have to keep in mind. But I do want to address one issue on the risk. People talk about, the debt in China, very significant debt. How should we think about it? Is it going to pose a downside risk? This topic comes up every year, right? Leverage in China, high debt load, is it going to cause problem? Is it going to cause a collapse in the Chinese economy? And then that's the end of everything. Well, take a look at this Chinese debt. Indeed, it has grown much larger. From 2008, after Lehman Brothers crisis, the $1 trillion of stimulus caused the debt load coming from 140% of GDP at the bottom, 139%, 140%. Today, we are looking at about 260% or so in terms of GDP, the total debt load. So within the total debt load, that's all the debt. Owed by who? Owed by the government, owed by the households, owed by corporates. Take a look at the screen on top, at the top part of the chart, where the dark blue color is a government debt. Government debt consists about 67% of GDP. So that's a local government, central government debt. And then the red part, 61% is household, owed by the household mortgages, car loans, personal loans, and things like that. At the top part, that's where the heavyweight is, corporate debt, 160% of GDP, 1.6 times of GDP. Okay, so 1.6 times of GDP. How do we think about it? Where is SOE in all this? Is it all owed by the private sector? Well, there's no clarity on how much is owed by private sector or SOE. But IMF did a study about 2-3 years ago, estimate roughly about this corporate debt, about half of it is owed by SOE, state-owned enterprises, government companies. Okay, then the other half is by the private sector. So 80% of GDP. So why do we want to know about this? Because if it's owed by SOE, so the chances are if something bad happens, the government will have to step in to do something. Right? Government will have to step in to do something. Then the question is, do they want to do it? Can they do it? Right? Can the government do it? Governments have the capacity or the bandwidth to manage the debt? So if you can see that the government debt load is about 67%, right? And the corporate debt, let's say 80%, so SOE, more or less, we don't have to worry. So we worry about the other part, the private sector, about 80%. So the Evergrande story comes out, right? Along this story, the Evergrande story, is it going to cause a systemic issue in China, default? Out of that top blue part, the Evergrande total debt, right, is around about 3% of GDP. So of the 160%, so every grand figure about 3% down there, 3% GDP. So it's huge, large for one company, but overall scheme of things, they contribute to that 3% point. So you have, of course, other property companies as well. So in terms of triggering a systemic risk, right? Triggering a systemic risk, I think the government is able and willing to prevent a systemic issue from developing, right? They would have to step in to prevent that from happening. So they are managing it now, so I don't see that kind of risk. And whether they have the capacity or not, take a look at the comparison across. Comparison across different countries. China, right in the middle, 280% or so. And next to it is Japan. Japan, JN, is supposed to be JP, I suppose, I think more appropriate. But anyway, Japan, you can see that it's 400% of GDP, 4 times of GDP. And UK, US on the right hand side of China, the total debt load in terms of the scale is roughly equivalent. Just that the component, the mixtures are different. And then you focus on the blue part. The blue part where China government debt is about 67% of GDP. You look across to the neighbor, Japan is 200%, 2 times of GDP. And UK, US, for comparison, is about 100%. So in times of trouble, the government has to step in. Where do they find the leverage? Do they have the capacity to leverage up further? And clearly, I think for China, there's room for it to leverage to prevent things from getting even worse, right? So there's room for China to move. If you want to worry, I think you should worry about Japan. It's already 200% of GDP for government. If things really bad or continue to be not so good, I think the leverage is going to be more and more difficult for the Japanese government to continue. All right, so this is the kind of picture to address the risk on China. So I won't lose sleep on this part. Yes, this is large. We need to pay attention. But is it the end of the world at this point? I don't think it's the end of the world. I don't think we are anywhere near end of the world for China, because there's room for the government to manage the situation. Okay, so last bit on this is on ASEAN. Okay, what I say just now, you may not agree. Why not we look at how the market is looking at the situation? How do they assess the situation in China? One is look through from the bond markets, bondholders' point of view. The bondholders, the red part is your Chinese government bond yield, and then the other one, the blue one, is treasury yield. You can see that the bondholders relatively confident about China. So there's no massive selling going on here. The bond yields holding steady for these Chinese government bond yields. How about the FX market? Well, the FX market, the investors there equally, I think, confident at least, right, or sanguine about what they are looking at China. So you can see the lines are going down. That means appreciation of the currency, appreciation of the Chinese currency. So far, I think they are quite comfortable with it, despite all this turbulence in your property market sector in China and also other worries about China. So far, I think it's still manageable, still confident in their outlook in that sense. Otherwise, you will see some selling off. Okay, so the last bit on this segment is on ASEAN. So ASEAN itself, we're also going to see some rebound. We're already seeing some rebound, for example, in Vietnam, after they get through from the Delta lockdown, and the situation, I think, continue to improve. One important thing is vaccination rates have gone up quite significantly for most of our ASEAN neighbors. I think Vietnam is already at 50% and Malaysia 80% or so, 70-80%. So the vaccination rates have really caught up, and that would prevent, or that would actually reduce the risk of this COVID-19 giving us trouble in this space. Okay, so what is driving this ASEAN growth? One of the important things is on the left-hand side is your PMI. You can see PMI all above 50. And then on the right-hand side is your exports, your trade, external trade. That's the other driving factor, right? As long as the demand from China, demand from US, Europe holding steady, improving, or even holding steady, that would help all these export-oriented economies in Asia, including our ASEAN countries and Singapore as well. So you can see the chart has been zooming up. On the line on the right-hand side, been zooming up. The exports have been performing very well to cater to the demand overseas. Cater demand in the US, China, and elsewhere. Right? So that's a very important picture that we have. And I think as long as the expansion, as mentioned earlier, as long as the expansion is there, it should be able to continue to perform. All right. And then the other thing, one last thing on ASEAN is that the foreign investors, foreign direct investors, investment investors, the inflows are continuing. The chart on the left-hand side will show you FDI inflows continuing to be very strong in ASEAN in 2021. That's November, December numbers. 144 billion in total compared to 100 billion a year ago. That is in 2020. So that is a kind of a confidence that people are showing, investing directly, their factories, their businesses in ASEAN. And of course, the bulk of it is into Singapore. But again, Singapore is a platform, a springboard for many of these ASEAN countries. So some of these direct flows are going, some of the flows are going into our neighbors in these in the ASEAN countries. So if you look at other, for example, in Malaysia, very strong confidence, right? After the punishment in 2020 from the pandemic, rebound in 2021. So very strong flows, very strong indication of confidence in this part of the world. Okay, so last bit, of course, for ASEAN is your ASEP. I won't spend a lot of time on ASEP. This is one important thing that we have going as well for this for our neighbor. 15 countries, one big integrated market, largest in the world in terms of population, GDP size, in terms of trade, even manufacturing, right? Accounts for a large bulk of the manufacturing in the world, all happening in ASEAN. So this big integrated market will be beneficial for our businesses and also for foreign investors coming into this part of the world. Okay, so that is the story for China. I won't lose sleep over that situation. And then ASEAN, a lot of good things are going. So I think the prospects still looking positive for ASEAN. Okay, the last bit is on Singapore. For the next 3 minutes or so, talk about the 3 rates in Singapore. The interest rates, just now I cover a bit. So watch out for that. My colleagues will tell you more what to do with how to manage it. Higher interest rates and then inflation rate. We are going to be seeing higher inflation rate as well. Here in this case here, higher inflation rate, look at Singapore. The expectation from MES this year, we are going to see 1.5, 2.5% of inflation rate. Last year already 2.3%. This year going on, the momentum is still continuing. So for companies, we have to watch this one because the cost of operation will go up. Right, you have already shortage of supplies for some of the businesses, facing shortage of material, shortage of supplies. Now they are also facing higher costs as well. So we do have to manage that. How do we improve the efficiency? How do we improve our sales through digitalization? Right, some of these improvement in efficiency could be done through digitalization, more technology, using robotics and all other things to improve that. So we do have to manage the costs. Okay, manage your cost, interest rate costs, and then your operating costs, and for consumers as well, right? Things are getting more expensive. Your chicken rice, right, getting more expensive. Your coffee getting more expensive, and all that. So for consumers and for businesses. And then the last thing, of course, added on to these 2 rates is your GST rate. Okay, your GST rate is in focus this year in Singapore. If you are operating in Singapore, so is it going to go through? I think the chances are. I think we are going to have to see higher GST rate, whether this year, next year, whenever. Why is it? I want to address the issue. Why is it that we have to talk about it? Is it because of the money that we spend from the reserve over the last 2 years, 100 over billion, we need to recover through GST? The question is actually no, not that straightforward. The more important question that we need to address is because, take a look at this chart. The first line here, the biggest jump in our expenditure is healthcare expenditure. That's pre-COVID, 2009 to 2019, right? 2009 to 2019. Pre-COVID, our expenditure on healthcare has really gone up every year by 13%. This is an annual rate, 13%. Because of aging population, you have higher quality healthcare, people are living longer. You know, you have fewer children and, you know, all sort of things. So you go to hospitals and stuff like that, and things are more expensive. So 13%. Take a look at our overall expenditure. The growth rate is only about 7% growth every year. So healthcare expenditure, really fast growth. How about revenue? Look at our revenue. Personal income tax is the fastest at 7%. 7% growth in our revenue, but your expenditure is growing at 13%, the big one. Corporate income tax, only 6% per year. And GST, somewhere down there, 5% every year, the growth rate. So obviously, we need to match our expenditure with revenue, not simply because we want to grab more revenue to pay for what we spend from our reserves, not that straightforward. So we want to do the matching properly. Our revenue must match with the expenditure. Okay, so here, take a look at our revenue. How is it going? Okay, the top three revenues that we have are corporate income tax, personal income tax, and GST. Okay, take a look at GST. It's the smallest component, so you want to leverage on revenue. That is probably one of the places to go for GST. Corporate income tax, we have the global minimum tax going to come into play. So how are we going to compete on that in terms of minimum global corporate tax? And personal income tax, we have our aging population, maybe fewer people working, and then how are we going to leverage on that part, right? So GST is one. Then the last bit I want to address is on this page as well. How about other tax, estate tax, capital gains tax? Take a look at the rest of the components. The revenue components are relatively small. So how are we going to leverage that? And the biggest driver are those flow taxes, your income tax, your GST tax, the flow taxes. Not so much on your asset taxes, right? Your asset taxes, take a look at the amount. How much are you going to increase COE? How much are you going to reduce a COE in order to achieve the kind of impact from your flow taxes? So I think GST is one of the things that we have to watch out. So grab your stuff before GST rate goes up. All right. So with that, I will end my session, and I'll pass the time back to Pat for the subsequent fireside chats. Thank you.
Thank you, Teck Kin.